Good evening, everybody. I just want to say a very quick warm welcome from Homegrown. My name is Jessica. I look after marketing and communications in this fabulous club. For those of you that are new here, we are a club specifically for high-growth entrepreneurs and investors. So we have our sister club Home House, a little bit more social focused, and this one is a club in which we help people to connect, gain investment, grow their connections, and all in all, just basically scale up their business. Our membership is completely sector agnostic. We have quite a number of members in FinTech and have been a partner with FinTech Circle for nearly 3 years now. Some of our FinTech members, Jonathan Quinn, some of you may know from World First. But yeah, we have a variety of sectors and over 1,300 members. Do have a wander around the club, and you've also got the opportunity to pop back. So do grab a voucher, but we'll be in touch regarding that as well. So, I know a lot of you have been to Fintech Week today. Hopefully this room is a lot cooler than it was there. And you've also got a glass of wine here, which is always nice, and the opportunity to network. But those of you that are going tomorrow, I really hope it's a successful day. But tonight is all about our panel, which I'm now going to hand over to the fabulous Susanne Chishti, CEO of FinTech Circle, to introduce. Let's give her a round of applause, everybody.
Yes, thank you very much, Jessica, and welcome to you all to our FinTech Circle summer drinks. It's great to have so many here with us, and so many familiar faces as well, founders, investors, lots of people from banks as well, and I'm very happy to welcome you because once a year in the summer it's a nice way to get us all together to really talk about the future. And today's topic is investment, the whole investment landscape, what the investment landscape looks like. For those of you who don't know FinTech Circle yet, so who are not yet members of FinTech Circle, so that's a company which I founded 8 years ago. And our inner circle is our investor network. So we meet about 3 times a year, and we invest as our own money into fintech startups in order to help them grow and scale up. So that's our FinTech Circle Angel Investor Network. And we have got 1 or 2 fintech startups here today as well, who will go through this process next Monday when we have our investor network at our partner Deloitte with Chris Hill, who is also a speaker today. So that's our investor network. Our wider network is then our books, which we publish. So we publish about 7 books in FinTech, and we also have now co-produced 3 films together with ITN. And our outer circle is our social media reach. So we're reaching more than 260,000 people now, daily across social media, across LinkedIn, Twitter, Instagram, where we can share your success stories. When as a FinTech Circle member, one of our goals is to share your success stories, to explain to people what your company is doing, what new innovation is you're working on. And in order to educate the sector, what is happening, what are the new trends and developments. And today's focus, as I said, is investing. And we are very, very privileged to have a fantastic keynote speaker today, Ben Hakham. And Ben is an investor himself. Ben also looks after the money for some of the wealthiest family offices in the UK. And I thought it would be so important for those of you who are either fintech investors yourself or who run fintech companies to understand how the macroeconomic environment looks like. Because we're all looking at interest rates, inflation is high, what does it mean, for example, to all of us? So that's what I would like now to welcome Ben as our keynote speaker to join me on stage and to share his insights, his expertise with you. And afterwards, I will ask Chris Hill to join us on stage to talk about, all these aspects and how they translate also for fintech companies and what you need to keep in mind when you raise funding, for example, or for investors, who want to invest in the best fintech companies, what are the tax benefits are. So that's the agenda for tonight. And after the formal part is completed, we will have more networking drinks to enjoy, just to get to know each other and speak afterwards more in more detail. With that, welcome Ben, please join us.
everybody. I'm glad I wasn't asked to jump onto this just yet, because it's going to be quite a climb. So, thanks very much indeed, Susanne. That's a wonderful introduction. Thank you for that. And yeah, I do asset allocation advice to a number of family offices in the UK and actually externally as well. My first ever family office I advised was actually out of Brazil, generic pharmaceuticals business, the biggest in the country at the time. Everything I'm going to I won't take much of your time on this, but everything I'm going to kind of talk about this evening is really surrounds this one significant point, and that is that if you think about the fact that baby boomers are aged today between 57 and 75, and the average age is 66, that is in the US, and by the way, I apologize for my concentration on the US, but that's kind of where we look at mostly because it's 60% of the financing market, so other developed countries particularly follow on whatever the US does. So keep in mind that when I talk about the US, I'm talking about UK, I'm talking about Europe, but just with a bit of a lag. So a fifth of the US population is the baby boomers, and a third of the working population are baby boomers. They are basically looking at exit stage left now, at quite a rapid pace. And that's putting a huge amount of pressure on the workplace. There are other things that are affecting it, and we'll talk about that in a second, but the aging population issue is a very significant one for economics, and for inflation, long-term inflation as well. So when we think about the aging population, you've got to think about a number of different aspects to that. One is that we're looking at an environment where clearly the pension industry is going to come under significant pressure because there has to be a funding gap that has to be filled. We have a scenario where ultimately the health costs are going to be rising significantly because somebody has to pay for that. We have a shrinking working pool and rising wage costs as a result of that. Now, the way that we've kind of always looked at asset allocation is really kind of 30,000 feet and then just get granular after that. So there are a number of structural themes that we look at before we do anything else. I'll talk about 4 of those today. One is that aging issue. The other is demographics. And what we are also witnessing at the same time is that whilst the aging populations tend to be more in developed countries, the developing countries are growing rapidly with a very young population. There is at the same time quite significant polarization in terms of income between those areas and developed world. And that's bringing this pressure that we're seeing today in terms of this economic migration that's happening where young people want to improve themselves by coming to find work in developed countries. It's not a surprise, it's not a shock, and it's to be commended because ultimately any developed country that's aging needs to have a young working population to keep circulating. We're going to be stepping into slightly political grounds here, but that's clearly there's a friction in terms of politics that's stopping that process from taking place. I'm going to stop there in terms of politics, otherwise I'm going to get pelted by stones. So demographics is one major element. And then the other is really around this concept of deglobalization. You can call it onshoring, insourcing, friendshoring. The idea that the national security is somehow being attacked by you producing somewhere else. So you should bring production back to your shores. You should bring as much of the IP as you can back onshore. And that should secure your trade and your industry going forward. Well, rational, makes sense. Unfortunately, that's the opposite of economies of scale. Because what then happens is that by definition, if you're producing less, your costs are going to be higher. At the same time, that workforce is getting tighter. You're finding it difficult to find the skill sets you need. And so again, those staffing costs are increasing. And actually, one of the interesting points I read the other day is we've known for a long time, of course, that employers ghost employees, future employees regularly. It's about a 75–80% process. or hit rate. Now, what I didn't realize was something like 25% of potential new employees are ghosting their potential new employers because they're getting so many different offers elsewhere, and they're just ignoring when the employer is actually offering them a job. So all of this is culminating from a number of different facets, and I think that's really kind of worth keeping in mind. And then the fourth, which is actually, I mean, all of those really quite negative in some respect. The fourth, which is a positive, is around disintermediation. It's around automation, AI, everything that surrounds pattern recognition, mass data sets. These are areas that are going to result in actual increase in productivity, should reduce cost over the long term, and in particularly with this environment, with this audience here, the financial sector is replete with data, and data that we really need to break down and understand better. And there's no other sector that I can think of that needs disintermediation as much as this sector, and I commend you all for trying to find ways around that. So let's kind of, having seen that kind of, if you like, sort of the really high macro perspective, drill down into what everybody wants to talk about, which is inflation and interest rates and recessions, etc. So let's think about, for now, inflation. So I tend to split inflation into two parts. One is the sort of structural inflation, the long-term impact of inflation. We've touched on that, and that is the baby boomers exiting stage left and raising the cost of work. That process, by the way, is also, there's an old concept that was put in place, that was talked about back in the early 70s, where if you are a retiring individual, and then you're going to rely on pension or other forms of income, you actually start to draw, you're actually becoming an inflationary entity, because you're not creating, you're not being productive, but at the same time you're paying for things and prices of goods and services go up. On the other hand, a worker, by definition, should be net productive, otherwise they wouldn't be employed. So therefore, if they are net productive, they're deflationary force. So again, we're seeing this kind of long-term inflationary force kicking in by the population becoming older and retiring. Other elements that I think sort of compound that from a structural long-term point of view is that the essence of inflation is such that we have to have a pricing environment that is not sinking into the psyche. That everything about inflation in the Weimar Republic or Zimbabwe when inflation went into hundreds of thousands is because the psyche changed. People expected to, with increasing cost of living, they expected higher wages, and so expected to continue to this vicious circle, if you like. Well, we're in that now. We have got wage pressure. We have got a level of psyche expectation wherever we are, and that, I think, is going to be difficult to break in the near term. So we need to keep that in mind as well. And then there's the short-term elements. And actually, the short-term elements, the news is good, because we've had durable goods or capital goods deflation for the last 6 months, continuously every month. We've had energy and commodity prices coming down. And we've generally seen that the logistics cycle is stabilizing as well. And all of those have resulted in those kind of inflation levels that we've seen in the US at 8-9% come down to the 4-4.5%, and that's probably likely to continue. The net effect, I think, from an inflation perspective, is that long-term Fed target of 2% is unlikely to ever be met, certainly over the next 5 to 6 years, because of those long-term elements around the boomer issues and that kind of tightness of the labour market. So interest rates. So what happens now? We've got interest rates in the US at 5.25%. The last episode that we had, when we had this rapid increase in interest rates, was in 1980 in the US, when the Fed raised in January of 1980 from 12% to 19%. But we haven't had this kind of episode since then, and I would argue it's actually worse now, because we got used to a cost of capital at 0, and now it's 5.25, whereas a cost of capital at 12% going to 19% it hurts, but you kind of already knew that it was expensive anyhow. and you planned in that way. So in a sense, what we've actually seen is this rapid increase in interest rates hasn't, I think, really impacted the economies of the developed world. Largely because the speed at which they've occurred, they haven't had a chance to translate into the cost of living impact. And what I mean by that, so if you think about it, and again, it's similar in the UK to the US, but the US average mortgage rate today is 6 to 7%. 97% of mortgage payers in the US pay have a rate of less than 6%. So as that process starts to unwind and you start to see an effect of refinancing mortgages, that cost is going to start to really feed in. Corporate bonds, there are more than 30% of corporate bonds that are going to refinance over the next 2 to 3 years. That's, again, most of the funding rate has been around 2 to 3%. You're now doubling that. These are companies that were effectively on razor-thin margins in the first place, and now you're asking them to double their funding costs. Banks are tightening up their credit regulation. MasterCard and Visa are saying that the credit pool is expanding. In other words, people are not paying down their bills as quickly as they used to. So there's certainly an argument to be made for a credit crunch coming into kicking in. And so kind of when I put it all together and you think about the effects of resilient employment on the one side, which is really driving consumer demand at quite a rapid pace. And we've seen that the consumer, both here, US, Europe, have been incredibly resilient. They've been spending largely on experiential type of product in terms of holidays and dining out, etc. But generally speaking, the consumer has felt confident in their job, rightly so. It's very unlikely that in this cycle we'll see that unemployment rate rise particularly high. And so when you've got confidence on the one side in your job, and you're happy to continue to consume, what's the problem? Well, from that point of view, there isn't one. From the point of view of the tightening credit market, the two are going to compete. So I think when I kind of conclude and think about what happens in the US particularly, which is the biggest market, I suspect we will skirt around the recession. I think we'll have low to possibly no growth, but unlikely to go into negative territory because of that competing elements of employment versus tightening credit. Europe is slightly behind that. I suspect that because we have a much more ossified labour market in Europe, it's very hard for people to sack and ride the cycle. So therefore, you're more likely to see a slowdown in Europe than you would have done in the US. And I'm afraid from when I kind of think about the UK, I remember when we talk about asset allocation, the UK accounts for roughly 2% of global asset allocation. And so not that relevant, but obviously here you care very much about what happens in terms of the capital raising environment, etc. But the UK has specific issues, and I don't want to be pelted by anything, so I'm not going to talk about Brexit or pre, post, whatever it might be. But the reality is we have got a food inflation problem. We have got a very tight labour market, and a labour market with imbalance in terms of the skill sets required, and that needs to be addressed. And I find it quite hard to see how all of that's going to be addressed without significant expenditure. And if that's going to occur, then I suspect that we're going to see sterling come under pressure, that whatever government comes in over the next 5-6 years is going to have to spend. The bond market's going to have to absorb all of that. And so unfortunately, I see the UK lagging significantly behind its neighbours, both in Europe as well as the US, in terms of growth. Potentially controversial, but that's kind of what I'm seeing. And then in terms of China, which clearly everybody's kind of looking to for some kind of reprieve, we haven't seen the post-COVID bounce back that we expected to see. Actually, last month's industrial production was up 3.5% versus 5.5% the month before. So it's actually slowing down again, if anything. And so the discussion now is whether there's going to be a stimulus to the Chinese economy, and we're getting closer and closer to that. So overall, I think when you kind of look at it from a North American perspective, we are in benign-ish territory. I wouldn't quite call it Goldilocks. From a European point of view, more negative. UK, more negative still. China probably doesn't save the day. I hope that's...
And what we want to do now is to translate what Ben said, about the macroeconomic environment specifically to your lives. About being an entrepreneur, being an investor, living in the UK, where we have got mortgages to pay, where we've got lives to live. So I wanted to ask Ben and Chris for a couple of questions which translate, to really what this means, because it sounded complex. It's like a complicated macroeconomic environment, and like Ben said, we've not seen it for almost 100 years. So nobody has been alive, nobody has done it already, practiced. We're doing it for the first time now. So the first question I had for you is, where do you see inflation going, Ben? And what is inflation, and why is inflation important when making investment decisions?
Yes, so Susanne, I think that clearly inflation is important because it erodes wealth. It's something that, if left rampant, will consistently take away value from everything in terms of both tangible as well as intangible securities. And so every government, every central bank will try everything possible to try and quell that, because, as I was saying earlier, once it feeds into the psyche, it's very difficult to reverse. And so the key element is to try and address at least there's very little that central banks or governments can do about inflation. Let's kind of call it there, because ultimately the market decides what prices should be. If you start to try and control prices, all you're doing is hiding the inevitable. The likes of many countries in South America and Venezuela try to control oil prices by putting a cap on the gasoline prices in the street. It doesn't work, because somebody has to pay for that, so it creates huge deficits. So ultimately, the market will decide where the inflation rate is going to be, whether it's for food or whether it's energy or wages, because wages are a secondary form of inflation. They then not drive inflation, but they create the environment that drives inflation in terms of companies having to then raise prices to accommodate those cost increases. So that's I think is why it's a really nasty thing to try and get rid of. When it comes to the level of inflation, every central bank has talked about a 2% long-term target rate. I suspect they haven't reviewed that or revised that because they're too scared to really tell everybody that we kind of don't think that we're going to see base inflation coming down to those levels again for a long time, and so that again drives the psyche. So they're happy to just keep sticking to that 2%. Having said what I said earlier about this kind of structural inflation and the short-term levels of inflation, that structural inflation is going to keep long-term inflation running at well in excess of 2% for quite some time because of that baby boomer effect, I think.
Excellent. And in terms of recession, Ben, do you see a recession in the UK coming or not?
Unfortunately, I do. I think that the UK, it is a homeowner community. There are elements of a significant element of disposable income that is about paying your mortgage down. And if, as we refinance our mortgages, and those are 2 to 3 year type of deals, and we're starting to have to remortgage at higher levels, then you are seeing a scenario where that disposable income is constricting and reducing spend and reducing consumption. And at the same time, we have significant food price issues which don't seem to be going away. And we're not back in the winter element in terms of energy issues yet, but we will get back into that again. So I just see that the disposable income in the UK is unfortunately getting smaller and smaller. But job security is still there. So whilst disposable income is falling, nonetheless people are still more or less employed. So it's quite different to previous recessions. So it should be a shallow recession.
Great, least I could use in a broader sense of things. And coming to you, Chris. So many of you will know Chris Hill. Chris Hill is a partner at Deloitte, a fintech partner, one of the best fintech partners and fintech advisors, lawyers, which I know. So many of the fintech startups probably might know Chris, knows Richard as part of the Deloitte team. And I wanted to ask you, Chris, because you work with lots of fintech startups, lots of fintech investors. What have you seen in terms of investment landscape? Because they are all, everything happens in our macroeconomic environment. So what have you seen in practice here, and what do you forecast for the rest of this year?
So there's no doubt it's been a very, very difficult 12 months. I've seen a number of companies that 2 years ago would have had an absolutely storming B round, C round, actually fell, just go into insolvency simply because there was so much nervousness in the investment community about releasing the funds, deploying the capital at that particular time, that it all just went wrong. Now, in the seed stages, I think it tends to be a little bit better. It's been a little bit more resilient. So in terms of the amount of capital being deployed, but the conditions under which it is deployed, so the conditions that a startup has to meet to get the funding, the prices essentially of the shares at which they're being sold, much more stringent. Investors are being much harsher in how they scrutinise the startups, not just in terms of have you got an idea, is it a really good idea, not are you going to make revenue, are you going to make profit, and how quickly. I need to see that quickly. So that it has been a very, very tough time for entrepreneurs. Some of the things that Ben's been talking about, I think we're already starting to see come into play a little bit. So something that I've seen a lot of startups talking about is doing debt rounds instead of equity, doing venture debt. There's so much more of that about now. Why is that? It's largely because people expect, rightly or wrongly, and from your very cheery weather forecast, possibly wrongly, give it 18 months, give it 2 years, it will have improved again, and then we'll go back out to market. But I don't want to give away that much of my company now at those sorts of rates. So they go off and do some kind of venture debt deal instead. I think one of the other effects that I've seen is that, particularly on the inflationary point, because inflation is higher and because interest rates are higher, outfits like family offices, for instance, are looking at other asset classes. So because interest rates have been so low for so long, if you've got capital to deploy, it's like, well, I'm not going to put it into something that's going to make no interest at all. So I'll put it into a startup instead, because you're going to have some hits, you're going to have some misses, but overall the return rate is probably going to be about X. If actually they can get that rate of X in a more certain way via bond skills or whatever it is, suddenly the less certain startup market doesn't look quite so attractive anymore. And we've seen that stuff in the scarcity of capital. When you look at the overall numbers though now, as opposed to in 2020, it goes to the psyche point very much. It's actually not that different. It's just that now we're on a downward cycle because 2021 was so ridiculous, and so people are a little bit scared, and that then becomes a slightly self-fulfilling prophecy. So that's what I've seen. In terms of what's going to happen up to the end of the year, I actually think, and this is very much subject to comment and disagreement, that the early stage end will start to pick up a little bit more as people realise, actually we're bored of holding onto our capital, waiting for something to happen, we want to go and invest in stuff. There's a big community of investors out there who want to get involved. So I think that will pick up. I think rounds B and C will continue to be difficult.
Yeah, that's great. Because you're right, I mean, if somebody says we've got a risk-free rate of 4% now, but equal inflation is 10%, so we're still losing 6% per year. So if we invest in startups, invest in other, invest basically, we've got the more likely the risk we don't lose the 6%. So you're right. A question to you, Ben. Ben looks after some of the wealthiest families in the UK, family offices, who run large pools of money. And where do you recommend them to invest in globally? So which are the areas which you think geographically which will outperform?
Yeah, actually, just before answering that, I just kind of want to take up one of Chris's points, which is absolutely right. And I was at a family office conference last week, and universally, every office is investing in 6-month bonds, whether it's treasuries or gilts, 5.5%, 6%. It's kind of, at the moment, it's just a very easy way to protect your wealth, and it is about capital preservation, protection of capital rather than capital appreciation, if you like. So what are we kind of looking at still from a perspective of where we find the best opportunities? It's really dull, because ultimately the US economy is still the most resilient that we're seeing. You touch on a very interesting point about interest rates here in the UK. When you think about the US dollar, it's the only positive of the major currencies, pretty much the only positive carry currency that we have. And so it's very likely that the dollar continues to see inward investment into both the currency and the country. It's where the consumer seems to be the most resilient. And it's essentially, whilst more expensive in valuation terms, is still got the highest growth opportunity and potential than we're seeing pretty much anywhere else. So US is really occupies still roughly 60 to 65% of the global asset allocation portfolio.
Great to know. For those of you who are new investors, who want to invest for the first time, second time, you all probably have heard the terms SEIS, EIS, and I wanted to ask Chris now to explain them in detail so that you really understand why these tax benefits are so beneficial in the UK and only in the UK. So maybe that's one area where we can really highlight the UK as a great opportunity for angel investors to invest in the best startups, because nowhere else do we get those tax benefits. But Chris, can you explain what those SEIS, EIS terms mean?
I can try. I'm a lawyer, not a tax guy, even though I work at Deloitte. I'm not a tax guy. So for me, this is the scary bit where I try to recite the facts, and there are lots of really experienced investors in the room, so please don't throw vegetables at me. So the core principle of EIS and SEIS is it's doing what taxation should do. It's trying to nudge behaviour, it's trying to encourage particular types of behaviour in a free market economy. The basic thesis behind it is, if we give people tax breaks to do a particular thing, they're more likely to do it. So if we want to encourage that behaviour, we are prepared to relinquish the tax revenue that we would otherwise get and spend on schools and hospitals and things, because we want to realise the benefits of the thing that we're trying to encourage them to do. So EIS is the Enterprise Investment Scheme, SEIS is the Seed Enterprise Investment Scheme, and sort of two tiers of roughly the same thing. Essentially, the deal is that if you are investing in a company, so you're subscribing for ordinary shares in a company, you get income tax relief, which means that essentially you don't pay income tax on that amount. You get CGT relief, so capital gains tax. You don't pay capital gains on those shares when you sell them. And there are other sort of bits around deferral and things, so you get essentially your tax bill is lower and that investment remains protected. There's a bunch of different conditions around it. As it suggests on the tin, that the SEIS, the seed one, is a smaller version, so on that you can invest up to £100,000. The company has to be less than 2 years old. With the EIS, so the bigger brother of that, it has to be under 7 years old, and it's up to £1 million unless, and this is very relevant to fintech, it's what's called a knowledge-intensive company. So there's a lot of research, there's a lot of fiddly stuff, then you can up it to sort of £2 million. There are various requirements around how that's done. It has to be a trading company, you can't be connected to the company, and crucially, back to that original thesis, it has to be money that you're putting at risk. Because that's the deal that they're trying to encourage, is to put your money at risk, go on, have a go, and we, the government, will help you make that work. It's been enormously influential, not just in fintech, but in the startup scene generally in the UK, in helping investors to take the plunge, and thereby helping those really early stage companies to to grow, to get the funds to research, develop, expand their ventures. And a lot of the big names in fintech and just in tech generally have at some stage benefited from exactly those tax reliefs. How did I do? Anyone that knows? Is that all right?
There's a final question from me before I open it up to all of you to ask questions in a second. Is I've seen today, a few days ago, Chris, you posted on LinkedIn about special videos which Deloitte created for startups, educational videos. Can you tell us which topics are covered and what education people can get?
Yeah, sure. So it's a series of videos that Richard here was instrumental in helping me pull together across all the different bits in Deloitte, of which there are many. The idea behind it is we deal with startups all the time. We often find that they've made mistakes on stuff that could have been prevented really easily if someone had just told them. We also know that startups don't read things, but they do watch videos. Short videos. So we put together this selection of, I think it's 19 different videos on the kind of stuff that Richard and I do. So contractual stuff, regulatory, there's employment, data protection, that's all the different legal bits. But then there's funding, how you get funding. There's VAT, business tax structuring, fin crime, etc., etc. The idea is it's out there. If you've got a question on a particular topic like share plans or whatever it is, there's an expert there talking for 2 or 3 minutes on what the main points are that you need to be aware of. Just as pointers, like think about this. So go and have a look at it, get some popcorn, point and laugh as necessary, and hopefully there's something in there that's useful. If you know a startup that's faced a particular challenge, there's probably something in there that's worth looking at.
Fantastic, Grace. Excellent. So let's open up for Q&A. So first question, the first row. Let me our microphone. Please stand up. Just introduce yourself.
Michael Brady, I'm Partners. Evening all. Thank you, first of all, for the very good session. I'm not an economist, so I'll probably let you down, but I did have a question on what you were talking about, the younger population being responsible for improving productivity, and how do you see this playing out in an AI world where AI is either augmenting jobs or replacing jobs, and there's fear, hysteria, and Prime Ministers obviously acknowledge this as a national issue. So my question to you is, what can we do to improve productivity and preserve jobs amidst this negative macro? Thank you.
Thank you. That's a great question. Actually, Americans always say it's a great question, so apologies. So, look, the reality is that AI has been with us for a long time already. Anyway, you know, I remember back in the late 90s when MasterCard and Visa were using neural networks to spot patterns in terms of fraud, etc. And so, you know, machine learning and deep learning is becoming bigger because the database is getting bigger across whatever marketplace you're looking at. And so, by being able to spot these patterns and create effectively more profitable lines of opportunity, because you are spotting these patterns, you couldn't do it any other way. That's the essence of disintermediation. Now, yes, people will suffer from disintermediation, but productivity overall should improve. And that should imply that, as an economy, there will be people who will fall short, but generally speaking, an economy should improve when you make processes a lot more efficient. And you take the world of finance. You know the process of borrowing for a mortgage or transferring money, whatever it might be. It's a very arduous, very expensive exercise. And there are so many firms now that are coming in to try and cut that process in significant time and cost. And I think as long as we continue to see those sort of benefits and really kind of advertise and focus on those opportunities and benefits, then we can kind of move away. I personally am not scared of AI. I'm not scared of it'll take over the world. and turn us into sort of a bunch of Terminators and come and kill us. But I genuinely think it'll help productivity and focus our minds on being more creative, our human minds more creative, whilst a lot of these patterns can be recognised through AI that we can take advantage of.
Yes, other questions? We've got here two questions here.
Thank you. Hi, my name is Mayank, and I'm from the startup world, so I represent the other side. My question is that between the risk-taking abilities or the investors in the UK and the European side, when we have the conversation, the risk they are willing to take is much lesser compared to the US side. Do we see any changes happening to it, especially in the AI market, where there are a lot of changes happening? So the discussions in these two areas is very widely different in terms of the valuation, how investors are interested to work with the startup entrepreneurs. So what is your opinion on that?
So I don't think it's AI specific. I don't think it's recent. That's been the case for a long, long time. That for whatever, I think broadly cultural reasons, people in the US, investors in the US, are just a bit more willing to take a bit more of a punt. And we, for a long time, we've seen that manifest itself, particularly at sort of Series C level, that there or thereabouts. That's why there have been so many fintechs that have grown up in the UK, got to that point and thought, actually, I need to go over to the US to get to that next stage effectively. It's something that the Khalifa report, Khalifa review a couple of years ago was quite specific on. It's like we need to bridge that funding gap at that point with taxation, legislative measures, and particularly around IPOs and the IPO process to make it more attractive to stay here and get to that point. Because of that, I could see situations, actually for a different reason, where the AI development in the US might be quicker, but a lot less safe in the US than it is here. And that other reason is actually data regulation. So the UK, Europe, so much more heavily regulated on a data protection level than in the US, where there are some states that are catching up, but quite slowly. All of AI is fueled by data. It is the fuel that drives the entire thing. Your ability to use a massive great data set for a particular purpose is so heavily regulated, or could be so heavily regulated, or not so heavily regulated. Why is it that China's so far ahead in this in so many ways? It's because they've got complete control over that data set and they can just use it how they want to. So it's actually because of that, more than because of that latent long-term difference in risk appetite that for AI, I think that there's probably greater development in the US, but probably with more unforeseen negative consequences as a result, I would think.
And I think this is very relevant for this community, is that this is a really, really good time for European, UK fintech firms to take advantage of this trend, because you keep in mind that the US financial system is actually way behind that of the UK and Europe in terms of development, and that's partly because of the sort of state nature of financial services. You've only got 4 or 5 big money center banks in the US, but the rest are really quite lowly capitalized, but as we're obviously seeing now, lowly capitalized banks with a huge exposure to commercial real estate. And the software and the platforms that they use are really quite antiquated. So this is a great opportunity to use this latest kind of new development in terms of product, if you like, in financial services for companies out of the UK, out of Europe, to really drive home their advantage over the equivalent in the US, because they're way behind.
Perfect. So 2 more questions. Yes, one gentleman over there. Then one here in the first row. Perfect.
Alexander Pisimsky, CEO and co-founder of Zenpulsa. Today, countries actually competing for companies to be settled in the country and like developing the innovation ecosystem. So, from your opinion, how is the UK like shown on this competition, considering especially financial sector, and like reminding the recent comments of Revolut CEO and co-founder about that if he will have chance to set up the Revolut again, he will not choose the UK due to regulation issues and inability to get through the getting the license problem. So what are your opinion on this?
So I think that particular example may be the exception that proves the rule for various reasons. I think the UK has an awful lot to recommend it. I think the Revolut thing is specific to Revolut for reasons that are not to do with regulation. They're to do with Revolut. But that's sort of an individual case. There are, I've spent a long time dealing with fintechs in their early stages as they start to develop their products and services, and this is something I've spoken about in these forums a little bit before. You have this uncomfortable thing with innovation where the people who are inventing stuff, by definition, are the people who do it first. The regulators are not the people who invent stuff, so that and the process is quite long-winded. So they're always operating at a lag. There's a thing that happened in December, the Edinburgh reforms. You sort of read about that, which basically said, look, we think there's a better way of doing regulation where we're going to move it to what's called a FISMA model, which is where you've got the regulators actually deciding the detail of how legislation works, how companies and therefore innovations will be regulated instead of it going through a full parliamentary process. And that, at first blush, that feels like just a technical, administrational, yeah, whatever, but it actually makes a massive difference. Because if you're operating, if you're trying to grow an innovative business in the European Union, where legislation can take years and years and years to get decided, then what's likely to happen, and I've seen it happen many times, most kind of, it's most accented way with open banking, is that the legislation takes so long to get through that by the time it comes out, the innovators have come up with a whole bunch of new business models to which the legislation doesn't apply. It doesn't work anymore. It doesn't regulate the right thing. In fact, it often regulates the wrong thing. And the regulators themselves are kind of powerless to do anything about it. This switch to a FISMA model, and we've got this, that there's a consultation that people are expecting on safeguarding and e-money that's meant to come out. So the first thing that's come out of this FISMA model for payments, that is so much more powerful because it means that the regulator, in this case the FCA, will be able to talk to industry and say, look, what's actually going on? Tell me what's going on now, and then I'll create the rules so that they respond to that particular business model. The effect of that is, if you compare those two situations side by side, in the European model, where you're waiting and waiting and waiting for something to be updated, so PSD3 for instance, in all that intervening time, you don't actually know if you're going to have to be regulated or not. You might be operating under a regime that just shouldn't apply to you at all, it gives you extra costs, and that stifles investment and actually stifles innovation. If you compare that to a situation where you can talk to the regulator and say, I think that this should happen because my business model works like this, and you never thought of that when you did the last set of rules, but actually this is how it works, and they can respond to that. If they get that process right, and that is quite a big if, that's a huge boost for the feasibility of innovating in a safe way in this country as opposed to any other. Get off my soapbox.
Chris, thank you. So final question was the gentleman over there. And then one here. Exactly. Yes. Yes.
Hi there, I'm Etienne from ECHO. So I had a question around the corporate credit refinance cycle that you spoke about coming up. I'm personally quite concerned about that and the impact that's going to play around the economy. What do you think that impact would be on venture capital finance specifically?
Thank you. Yeah, I mean, I think that clearly there is a relatively finite pool of capital that's available for investing. The corporate bond market is huge, as you know, and so that refinancing is going to take out quite a significant amount of that money out of the private sector. This is not public sector, this is out of the private sector. And I suspect that it will have a deleterious effect on venture, because ultimately, whilst you look at venture as a relatively small part of your asset allocation model, and you look at, you know, when I think of family offices, the average would be 2 to 3% allocated towards venture. Clearly, as interest rates are so much higher, that immediately puts a cap on valuation at venture capital level. And at the same time, you've got competing asset classes to venture in terms of risk-adjusted elements. So I agree. Unfortunately, I think it does take away some part. It takes away, particularly in the family. I can only really speak from family office world. I think our family offices are quite concerned about this development, and I think that they are very wary of putting more money, certainly into venture funds, because they're not seeing the returns. Even on the, you know, think about the fact that the vintages of venture capital funds over the last 4 or 5 years, investments have been kind of done at the wrong price, right? So you're getting to a point where it's actually, if anything, it's venture capital firms launching now that are in a better position, but nonetheless, for those there is less capital to raise, but so each one has a problem. But the reality is venture capital returns are not great already, and we've had the greatest opportunity to make them great, and now we've got a higher cost of capital. What's next?
Thank you for the positive feedback.
Yes, last question, gentlemen.
Hi, I'm Simon Harris. I'm actually also part of the ECHO team. I promise this was not planned. I had a bit of relief. I breathed a breath of fresh air when you said that the kind of early stage startups were sort of receiving, you know, good funding. My question is, are the funds focused on VC, PE, focused on Series B, Series C, going to look to change their investment hypothesis? And if so, how do startups like us tap into these, let's call them amendments of trajectory?
I can talk to that. What we see in our FinTech Circle investor network, we see more companies coming to us, which often would already raise the VC range, but because VCs don't invest, they come to our angel investor network. And we had our last round was very, very successful. So we had in February our last event where we had lots of investments going in our investors, and these are all very sophisticated, smart angel investors who have got strong expertise in financial services. And they have been investing because they also the valuations were realistic, you know, and people feel that the future vintage years will be good ones. Like what you said just, Ben, that investors who start investing now, when valuations have come down a little bit, will probably have good returns. And so investors at early stage are interested to do that. And I think later stage VCs, PEs, they have got the issue of refinancing, which you just talked about, so they only can invest if they get invested. You know, they don't invest like angels invest their own money, while VCs invest other people's money. And if they don't get from somebody else the money, they can't invest it on. So they have got this dependency, and if they've got poor returns in the past, they can't get a new fund raised. And often what they're doing now, they invest in the existing portfolio companies to keep them alive, instead of investing in new startups. So that's what's currently blocking, you know, the VC, PE world. And so that's why we see that in our investor network at angel stage, you know, we see lots of demand from startups to get funding in, but because valuations came down, we see lots of our investors, you know, being interested in investing now because they have got a long-term horizon again, which is different to a VC who's got a 7-year horizon, because after 7 years you need to return the money to your investors. Whereas an angel, you've got a longer term horizon, you don't have this deadline to meet. So, with that said, so thank you all for the great questions, and for our panel members. So Chris, thank you very much for sharing your knowledge. Ben, thank you for sharing your wisdom and knowledge. And now open up for more networking and drinks and getting to know each other. It's amazing how many people came today, although it's so hot, but it shows our FinTech Circle events draw the best entrepreneurs and investors and experts together. So I want you all to get to know each other. So even if you don't know people, just say hello, and have a conversation. And thank you all for coming, and enjoy the next hour or so together.